Let's look at what happens when someone sells their personal residence. Typically, if you have a gain or loss on selling that residence, it's capital. It's either a capital gain or a loss. If it is a capital loss, it's not deductible because it's considered a personal use asset. Part or all of the gain might be excluded if the taxpayer meets certain requirements if they do sell at a gain. The maximum exclusion for the gain is $500,000 if you marry filing jointly, or $250,000 for all other taxpayers. Any gain in excess of that exclusion amount is taxed at long-term capital gains, and that's good news because it gets preferential or preferred rates rather than the ordinary tax table rates. In order to qualify for the exclusion of a gain on the sale of a residence, the taxpayers must meet an ownership test and also a use test. The ownership test states that the taxpayer must have owned the property for 2 or more years during the 5-year period that ends on the date of the sale. Those do not have to be consecutive years. If they're married taxpayers, either spouse can satisfy the ownership test. So one could own it for any 2 or more of the 5 years, and the other one does not have to. At least one has to. And so the reason there's this requirement is the Internal Revenue Code in Congress, who developed that, realized that a taxpayer could buy a home, fix it up, and sell it at a gain and call it personal residence interest, and exclude the gain. That's not the intent. The intent is not to exclude gains for investors, but rather for home owners. The use test says that the taxpayer must have used the property as their principal residence for at least 2 or more years during the 5-year period that ends on the date of sale. If the taxpayers are married, both spouses must satisfy the requirement. It's meant to ensure that taxpayers are, again, selling homes that they actually lived in and not just bought and didn't use and then sold at a gain and just to exclude the gain. The example is that Tyler and Jasmine were married, and then Jasmine moved into Tyler's home in Denver, Colorado. Tyler had purchased the home 2 years ago, so Tyler meets the ownership test. Then, after being married, they lived in the home for 3 years as their principal residence, and then they sold it. So Tyler was the sole owner of the home for all 5 years, and so the question is, even though Jasmine didn't own the home, can they deduct the gain on the sale? So does the sale qualify for that $500,000 exclusion of gain for a married couple filing jointly? And the answer is yes. Only Tyler had to meet the ownership test, and both had to meet the use test, and in this case they did, so they are qualified for that exclusion of the gain. There are some exceptions to the general rules. So first of all, if there's non-qualified use of the home, in other words, it's not considered a residence, it applies if the non-qualified use occurs after January 1 of 2009. And the non-qualified use includes time the home is not the taxpayer's principal residence. And it doesn't include the portion of 5 years that ends on the date of the sale after it was last used as a principal residence by the taxpayer or that person's spouse. So really what that third one means is if someone lives in a home and then they move out of that home, as long as they sell that home within 5 years, that's not considered non-qualified use, even though they're no longer living there. What the situation is meant to avoid, or the tax laws want to avoid, is someone using something for personal use, then moving out and having it as a rental, and then moving back in, maybe moving back out. So what they're saying, though, is if you end your use of that residence as your personal home, it's not a problem if you wait a while or if it takes a while for you to sell it. It still could qualify for the exclusion of the gain. The amount of the realized gain that's eligible for the exclusion is reduced based on the percentage of how much non-qualified use there is divided by the period of time in which the home was owned. In hardship instances, these rules or these exceptions are again available to taxpayers. So for example, one could be that they get a new job in another area, so they don't stay and use that home for the entire 2 years. Well, then what they do is they take the portion of the 2 years that they were living and using the home, and divide it by the full 2 years or 24 months to get the fraction. It's not a fraction of the gain, it's a fraction of the maximum exclusion. So in this case, if you had $500,000 for married, filing jointly, or $250,000 for anybody else, any other taxpayers, you multiply that available exclusion by the fraction that is the number of months actually owned and used versus the 24-month, which is the 2-year requirement. So if the qualifying months then end up being less than 24, again, you're going to have a fraction. So here's an example. The couple moved from Denver, bought the home in Chicago for $375,000, and they moved in July 1st of year 0. But just a few months later, 6 months later, January of year 1, Tyler accepts a new job. And so they have to move, and so they sell their home, and they have not lived in that home for the required 2 years to meet the use test. So how much of the gain on the sale, which is $525 minus the $375 purchase price, can they exclude, and at what rate would that be taxed? So the answer is that they are going to have a $150,000 gain realized minus a portion of the exclusion. So if they had waited a full 2 years, they could have excluded up to $500,000. But because they were only there 7 of 24 months, they only have $145,833 available as an exclusion. Anything above that, which is the $4,167, is taxed. It's a taxable gain. And because they did not stay in that home, it is long enough, it's considered ordinary. So they're going to have to pay ordinary tax rates instead of capital gains preferred rates. We'll move on to 3 to further discuss the deductions that are related to homeownership.